Till now, we have seen theoretical portion. Now we are coming to practical aspects. Theory is important to understand so that we can experiment in practical life. But there is difference in practical world and theory. Long call is our first single leg strategy and it is most common strategy followed by retail bulls. Long call means buying a call. It is simplest of all option strategies for retailers because they keep buying out of money calls most of the time for any reason. For example, when there is a breakout, they buy call. If underlying has fallen a lot and they think it will go up, they buy a call. There are high targets given on TV, they buy a call. We have seen what are rules for option buying. We will go through them again in practical way now. Long call is bullish strategy. Long call is bullish strategy which comes in debit trade category. It remains so in theory as well as in practical. When should we buy a call? We should buy call when we expect rapid up move in underlying or if we expect big targets. If movement is sluggish, price appreciation will be very slow in option. Theta decay and volatility play big role in option prices. So in case underlying moves very slowly, we will not be able to gain as much as we should. To reduce effect of IV fall and premium fall, we buy option when IV is in zone 1 or zone 2. For naked buying single leg, we have to buy option in zone 1 only. We cannot buy naked option in zone 2. Or rather, we should not buy naked option in zone 2 when our view is for longer time, more than 5 days. If we are willing to hold for more than 5 days without price appreciation, then we should buy only in zone 1. Prerequisite for call option buying are uptrend in underlying and IV in zone 1 or zone 2. Earlier we had discussed that we must buy option which has expiry of 90 days or so. This helps us by keeping theta to minimum because expiry is far away and Vega has highest positive effect on option prices for farthest expiry. By this rule, we cannot buy any stock option in India. Basically, Nifty and Bank Nifty are more than enough in India for option buying because of sheer volume and movement in them. If we can master one strategy of option buying in Bank Nifty, it can give us a profit of 1 crore in a day if we can take adequate risk. This has been achieved by one trader and you might have seen his videos. For that, one has to become a full-time trader. It took him 8 to 10 years of dedicated trading in Bank Nifty to reach this level. So nothing comes without efforts. There is another trader who trades only in Bank Nifty and makes 5 to 7 lakhs profit by capturing just 20 to 30 points move in Bank Nifty options. And that happens within few minutes once in a day. He waits for his setup to develop and this is possible just because of sheer volumes in indices. I am telling these examples just to tell that option buying for short term can give huge profits, but risk is also similar. Theory wise, we should not buy options in Indian stocks because they are liquid only up to 45 days at the most, and recommended time period for option buying is 90 days to expiry and rollover is recommended when 60 days are left. These recommendations are to avoid losses due to theta decay and it gives advantage in volatility. But practically speaking, one can buy options in Indian stocks with different rules and application of option Greek knowledge. Let's consider this. When we buy a call option of Bank Nifty for strike of 38,000, which is at the money at time of decision making. Then option premium for weekly and monthly options are different. Weekly option premium may be 400 rupees, monthly option premium may be 900 rupees. There is big difference in premiums. This is because of theta and vega. Far expiry means monthly option has more extrinsic value, and theta decays more in current weekly expiry, but theta value is more in monthly expiry because extrinsic premium is more in monthly expiry. What happens when IV is high at the time of buying an option? When IV is high, premiums are very high. And because of high premiums, decay is also very high. So this rule of buying option when IV is low must always be followed without any exception. What happens to option premiums when they become deep in the money? For deep in the money options, premiums for weekly and monthly options do tend to come closer to each other. Premium difference between them is less than that of at the money options. Why is it so? Because for deep in the money options, extrinsic value is very small. When extrinsic value is small, that means theta will be small and vega will also be small. When we buy at the money options and they become in the money and deep in the money with favorable move as anticipated, usually profit comes from delta. But simultaneously for far expiry, extrinsic value decreases more than that for near expiry. So 400 call premium may increase to 2700 and 900 call premium may increase to 2900 if there is move of 2200 points in our direction. This may be difficult concept to understand. We will be able to understand more on checking historical data. But carrying deep in the money options definitely has disadvantages. They are very less liquid in stocks and relatively less liquid in indices. Because of this, traders exit in the money options and shift to at the money options most of the times. This is the reason that there is high volume for at the money options all the times. If in the money options are not squared off before expiry, then there are chances of getting assigned. Due to lack of liquidity, spread may be larger and one may not get actual price which option should have, or it may even be possible that there will not be any buyer when we want to sell the option. As stock options are being settled physically, we need to buy the share at expiry if options expire in the money. It is not a big problem to hold in the money calls because there will be intrinsic value which will most likely give profit. But holding at the money call which has very small intrinsic value may be problematic, especially when there is possible down move expected in coming days. We need to understand process of assignment and what happens after that. On day of expiry, stock options should be squared off or broker exits them. This is standard procedure. But if there is no other party to square off the position, then it becomes a big issue. Even broker will not be able to exit the position and then call buyer will need to buy underlying. That means call buyer will now need to arrange money worth full lot cost and take delivery, or else there will be penalty on buyer. In India, settlement is on T+2 day. So same way, options also get settled on T+2 day. Expiry is on Thursday and options are expired. So options after expiry are settled on Monday when Friday and Monday are working days. This is same for option buyer as well as option seller. Call option seller has obligation to give delivery. This means call seller has to give shares to call buyer and take money from call buyer. Suppose someone has bought call of TCS at 4000 and TCS expired at 4001 on expiry. Call buyer did not exit his position, then call seller has to give delivery of shares to call buyer at 4000 rupees. What happens in this case? Call buyer has to pay full amount to call seller. Lot size of TCS is 150. Total amount required will be 150 into 4000, that is 6 lakh rupees. Call buyer needs to pay 6 lakh rupees and take a delivery. On the other hand, call seller has to buy shares from market if they are not available in his account. In this case, problem can be big, either for buyer or for seller. So TCS expiry was at 4001 in example. Now buyer doesn't have money in account. Buyer is not able to pay 6 lakhs rupees to buy full quantity. In this case, there is penalty on buyer. I don't know how much is penalty, but for this reason there is increase in margin requirement near expiry. And if buyer has money, then he pays money and takes delivery. Buyer gets stock at the strike price decided, which means at 4000 rupees. This settlements happen on Tuesday. If TCS remains at same level or higher on Tuesday, then buyer has no problem. But what will happen when TCS falls by 10% or more by Tuesday? Buyer still has to take delivery at 4000 rupees per share. There will be 10% fall in his total value. Now let's come to call seller. What happens to call seller? Call seller has obligation to give delivery at 4000 rupees. Now if call seller already has purchased share from market and is able to give delivery, then he will not have any problem. Broker gives delivery of those shares and matter is settled. But when call seller doesn't have shares in account, then they need to be bought from market. The process of buying to give delivery is a bit complex. Call seller has to buy shares from auction, because even if shares are bought in market, they get deposited on T+2 days and delivery cannot be given till shares are deposited in CDSL account. Since shares are not available for delivery, broker has to procure them from auction. Auction is a special process where people can auction their shares. Usually in auction, cost of shares is very high. Stock seller can ask any price in auction and call seller has to pay that price and procure the shares to give delivery. If shares are not available to be sold, then exchange levies penalty of 20% to call seller and pays that cash to call buyer. This is straightforward loss of 20% to one who has to procure shares from auction. So even if share prices fall in 3 days, one who needs to procure shares may need to pay higher prices. And if prices increase in 3 days, then share price in auction will be definitely more than strike price determined. It is always better to square off stock options when they have some value. It is not good idea to wait till it becomes worthless. Index options can be left alone as they are settled in cash and not physically settled. There is one more thing which we need to know. There was one example recently shared. Some person had sold put. Value of that put was 5 paise at the time of expiry and it expired as out of money, just out of the money. So it was just out of the money option, but after some time it was declared that that option has 35 paise value and it is in the money. How did this happen? To understand this, we need to know two terms. One is closing price and other is settlement price. Closing price means the price which is traded last at 3:30 p.m. and markets closed at that price. But settlement price means average price of last 30 minutes of trading. Many times we see Nifty last traded price is different and when we see post market price shown is different. This is same for stocks as well as indices. Because of this reason, sometimes it is possible to get at the money option to expire just out of the money as per last traded price, and then it becomes just in the money after recalculations. I had never paid attention to these facts because I trade mainly in index options near expiry. I do not hold stock options for expiry. We know these rules. We can take advantage or we can take precautions. Best is to avoid non-liquid options and avoid carrying options till last day. So basic rule to buy an option is IV should be low at the time of option buying and script should be in uptrend. Now characteristics of long call as stated in theory are limited risk. But this is false, because if it becomes in the money at expiry, then there is big issue. Reward is said to be unlimited for buying calls. But how many times can one hold on to get unlimited reward? At the most, people exit once option premium is doubled and keep holding if it is in loss till it becomes worthless. There is no point in saying return is unlimited. Return depends upon how much was risk taken on portfolio and how much was position size created. Someone may buy Bank Nifty option which is worth 10 rupees as a lottery and book it at 100 rupees by luck. But if position size is very small, then even this 10 times return on capital deployed doesn't have any value. Risk and reward must always be calculated on total capital and not on capital deployed. Break even at expiry, which we had discussed earlier, for buying a call is strike price plus premium paid. It is break even at expiry. But we must not keep options till expiry, because if they expire in the money, then there are different rules which we have just discussed. Now let's see implications of Greeks on call long position. Long call is delta positive. As underlying moves up, call premium increases with proportion of delta, and there is decrease in premium similar to delta when there is down move. This gives dynamic leverage effect because of gamma effect, as we have already explained in option Greeks. Long call is vega positive. That means increase in IV will cause increase in option premiums. Vega is highest for at the money option and decreases in away strikes. So when implied volatility is low at the time of option buying, any increase in IV will increase option premiums. But what happens when there is strong move which is favorable in our direction? We do not earn on vega after that. We earn on delta. Vega in fact becomes lower and lower for in the money options because intrinsic value is more and extrinsic value is less for in the money options. So after big moves, premiums of option increases with delta and vega doesn't have much effect. Delta is same for all expiries. So near expiry or far expiry options will have similar gains. Far expiry options will not have any advantage of vega when move is rapid and options become in the money. Long call has negative theta, means theta decay causes premium decay. Theta decay is maximum for at the money options. So at the time of option buying, to minimize theta effect, we need to buy options which are in far expiry. But if we are taking a position with view of strong momentum and rapid move in few days, what will be effect of theta? If move comes in direction anticipated, then option becomes in the money option. For in the money options, theta decreases as intrinsic value increases. So conclusion is, when rapid momentum is expected, delta is friend of option buyer and delta increases price of option rapidly when option becomes in the money, and it is same for near expiry or far expiry. effect of theta and vega become less and less as option becomes more and more in the money. So when there is rapid move, option becomes in the money very soon. This means vega and theta play less role in rapid moves. Far expiry options have more extrinsic value. So when options become in the money rapidly, their theta value, vega value decrease more than for near expiry. So if we are anticipating rapid move in underlying within 5 days, we can buy options in stock. Minimum 4 weeks away expiry should be chosen because most rapid theta decay is in last 15 days. So 4 weeks to expiry with view of strong move within a week allows us to have some space to play with relatively small theta decay. This is practical approach. So I will modify third rule of buying option with 90 days expiry. Buying option is feasible for 30 to 45 days expiry, but with strict stop loss in terms of time and price both. Time stop, as I have already mentioned, should be less than 5 days, and better to avoid option buying on weekends and in weeks when trading days are less. For 90 days expiry, one can rely on price stops because option premiums decay slow in farthest expiry. In near expiry, momentum must come, otherwise decay hits option buyer. Is this new concept acceptable to all? Any doubts in this? Now let me summarize long call. We buy a call when underlying is in uptrend. Do not buy a call in downtrend. Buying call in downtrend means donating money to market. Buy naked call when IV is in zone 1. We can buy naked call in zone 2 as well when rapid momentum is expected. Expiry selection depends upon short term view or medium term view. For expected rapid momentum, one can buy option which has expiry of 4 weeks minimum. For long term view, minimum 90 days expiry is the best way to avoid decay. Rollover is essential when expiry is less than 60 days in these strikes. And how do we select strikes? We buy options for at the money strike or slide in the money strikes. They are best to buy because they have best effect of delta and vega.